TD Bank just weathered a major scandal, and now they're facing a global recession and, of course, Trump's tariffs. But the question becomes, is it time to panic or is it time to buy? Fasten your seatbelts, folks. This is going to be a good one. TD Bank isn't just another member of Canada's big six banks. They are pretty much a cornerstone of Canada's financial system. We're talking 27 million customers, a massive US footprint, and, well, a long-standing reputation for stability. A reputation that was, well, recently tarnished big time thanks to a money laundering scandal in 2024. In fact, many investors are asking if TD has put the scandal behind them and if they're prepared for what is to come. We're talking about the worst part of the mortgage renewal wave, Trump and his tariffs, and more than likely a recession later in the year. Oh boy, let's start with that money laundering scandal. Last year, TD was hit with serious allegations of money laundering failures, particularly in its US operations. This wasn't just a slap on the wrist. Regulators opened investigations, fines were floated in the billions, and, well, in the whole process, TD's image took quite a hit, especially amongst those American investors. But here is the key. TD, well, they responded, which is good. They overhauled internal compliance, injected millions into risk management tech, and slowed their acquisition of US assets while they cleaned house, which of course included naming a brand new CEO. Their response has absolutely been the best it probably could have been, and that's a good thing. Turning to those tariffs, there is some vulnerability for TD Bank because almost a third of their income comes from the US and their retail banking footprint down there. Tariffs, of course, mean more pressure on Canadian exports and possibly even a weaker loonie. That could strain business lending and cross-border operations, but at the same time, it could also help some of TD's US revenues when they're converting them back to Canadian dollars. Indirectly, tariffs could lead to more business and personal insolvencies, which they need to take into consideration in terms of loan loss provisioning. They are well prepared for the pandemic mortgage renewal wave, but this will add more pressure, and provided they provision adequately, they actually should be fine. Of course, the big fear coming out of all of this is that Canada will head into a recession. Luckily, TD's fundamentals have been strong, as we're going to look at those in a moment. With that being said, bank stocks do tend to take some heat in a downturn. Loan defaults rise, credit demands fall, and, well, net interest margins tighten. The good news, though, is that TD's conservative lending practices and capital buffers it does give them a certain amount of protection. A sub to the channel is your protection from missing future content. As you guys know, I do like to read their latest quarterly report, and, well, then I will, of course, report back with a few key highlights. The quarterly report that I read this time, of course, is their Q1 2025. I will point out, though, that the Q2 is actually going to be released a little bit later in the month, towards the end. So what interests me in this latest report? Obviously, loan loss provisioning is something I was highly interested in, and they did not disappoint. TD increased their total loan loss provisions to $1.21 billion. Now, that's up from $1.11 billion from the previous quarter. I would not be surprised to see that number rise even higher in the Q2 report that's coming out at the end of the month. Another point, they are in the process of restructuring their US balance sheets as they have reduced their overall US assets by 10%. So they're definitely shoring up that side of the border, and I do like to see that. In addition, they have made progress on that US anti-money laundering remediation. An independent monitor has been appointed, and they are actively enhancing technology and investigative practices. Most of their efforts are scheduled for completion this year in 2025, with full implementation extending into 2026 and a little bit into 2027 as well. Okay, I do think it is time we get into those fundamentals. Of course, if there are numbers involved, we need to call on the Einstein of equity, the Commodore of computing, the one and only Mr. Math. We will start off with a little bit of their surface data. So at the time of recording, their current value coming in at $87.91. They've got a nice looking market cap of $154 billion. That beta, very average, 0.98. So they're pretty much as volatile as the market average. Their earnings per share coming in at 4.72. And that price to earnings ratio, that's coming in at 18.63. Now, the average amongst their peers, 12.8. A few of those peers include CIBC with a PE ratio of 11.3, Bank of Montreal's coming in at 12.7, and Scotiabank has a PE ratio of 13.7. Switching to their price to book ratio, that is coming in at 1.42. Their return on equity, 7.61%. And those return on assets, 0.44%. Those return on assets, they look low, but with banks, they do tend to come in on the low side. So that's actually not a bad number at all for a bank. Overall, these numbers do look pretty darn good. Okay, let's peel back another layer and take a look at their cash flow data. Their revenue coming in at $53.37 billion per year. Their earnings coming in at $8.27 billion. Now, those earnings, they are projected to grow by 4.46% per year over the next 5 years. Looking at their profit margin, not bad, 16.51%. Now, their free cash flow, it is in the negative $83.23 billion. Operating cash flow, negative $81.03 billion. Yes, their cash flow is deeply negative, and, well, that was actually expected to be so, as they're continuing to beef up their cash loss provisioning. We know where that money's going, and that's not a bad thing at all. Looking at their fair value. At the time of recording, once again, their current value was $87.91. Using a discounted cash flow model, we do get a fair value of $149.33. This paints them as being undervalued by 41.4%. Looking at the analyst's 1-year target on this one, $91.20. So that is an increase of 4.3%. I will definitely say take this one with a grain of salt. This target could be off quite a bit, as I think how well they have provisioned for loan losses could play a huge role either way. Thus far though, they have done very well, and I'm anticipating them to continue in that vein. Okay, let's turn the page and look at their returns data. Looking at their dividend, they have a yield of 4.803%. It's a quarterly dividend of $1.05 per share. Payout ratio on that, 87.08%. Their 5-year average dividend increase, that works out to 6.58%. Now, TD is a dividend aristocrat with a streak of 14 years of consecutive dividend increases. Switching over to returns. On their 3-year return on investment, that is coming in at negative 3.83%. Factor in the dividends, total return 9.08%. The Big Six struggled quite a bit about 3 years ago, and that is really reflecting in these numbers. But when we look at the last year, so their 1-year return on investment, much better, 14.45%. Add in the dividends, total return 19.94%. 3-year annualized, it's a little on the low side, 2.94%. What this data does not show is that for the most part, they have actually done fairly well in the initial waves of tariffs. And that's a good omen for sure. Okay, let's take that final dive and look into their debt data. They have a total debt of $493.58 billion, total equity $119 billion. So that is a debt to equity ratio of 414.8%. Not surprisingly, that debt to equity ratio has risen from 301.5% over the last 5 years. Switching to cash and cash equivalents, that's coming in at $645.08 billion. This is where some of those loan loss provisions are living. This is a very deep moat for sure. Now, on the short term, they have assets of $704.70 billion, liabilities of $1.71 trillion. On the long term, their assets $1.39 trillion, liabilities $260.17 billion. TD's debt situation, it's not that bad at all. Definitely don't be fooled by that high debt to equity ratio, as that is part of the business model for a big bank. In addition to that, they have sufficient allowances for bad loans. And, well, actually, 68% of their debt is made up of low risk funding sources. So that's not too shabby. What it does boil down to is that they have a moat capable of carrying them through a lot for sure. Now, in the last year, there has been no significant share dilution at all. Gotta love that. Okay, we have enough information for that final verdict for sure. I like this bank overall, and it goes without saying, they do have what will be needed to navigate the coming economic chaos. They will be just fine on the other side. The question should more or less shift to how they will do along the way. I do think we are going to see resilience in the banking sector, and TD, with the money laundering scandal behind them, will be in the fray for sure. If you're a long term investor with a risk tolerance for volatility, TD definitely offers one of the best combinations of stability, US exposure, and income in the Canadian financial sector. However, for short term investing, there's got to be that volatility. The combination of macroeconomic headwinds, renewal shock, and political risk from the US will make this a bumpier ride for sure. Nonetheless, when all is said and done on the other side, this stock is going to be absolutely just fine. If you are interested in TD, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on brand spanking new ETFs. Thank you for watching, and I will see you in the next video.